Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti. On behalf of OTC Markets, we're very pleased you joined us for our third and final day of our Metals and Mining Conference. We'll start today with a live presentation from Sage Potash. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Peter Hogendorn. He is the Chief Executive Officer of Sage Potash Corp, which trades on the OTCQB venture market under the symbol SGPTF and on the TSXV under the symbol SAGE. Welcome, Peter.
Welcome. Thanks for having me. As an introduction, perhaps I'll introduce myself. I've been in this business for 35 years, financing mining deals, technology deals, and just as a bit of a background to this project, I've been involved in this project in its first iteration, since its first iteration 10, 12 years ago. We discovered this deposit by some research in looking for potash in the U.S. We felt that the U.S. needed its own potash source in that it relies 97% on imports. So in doing our research on potash, we came across some reports, and one of the reports we found that this was a deposit that was mapped by the USGS back in the 70s and 80s at a time when the deposit was too deep for conventional underground mining or strip mining. So, but he knew that when he mapped it, it was just a matter of time before technology would kind of catch up to the depth. And those technologies are essentially directional drilling and solution mining, which didn't exist back in those days. So we put together a package that we intended to go public with 11 years ago. And before I could do that, I ran into a gentleman that was a serial miner, had numerous operating companies in Australia, South Africa, anything from oil and gas to platinum to copper. And I just asked him as a reference. I asked him what are his thoughts on potash, and he said, well, depends where it is. And I said, well, it's in Utah. And he said, let me have a look at it. So he took a look at it. A week and a half later, he got back to me after reviewing it with his team. And he said, this is probably the best project we've ever seen. We'd like to do something with you on it. But we don't want to, the problem is we have a shell that's got $16 million in it. And we don't want to give up control of the shell. So we came up with a strategy of doing a joint venture where they had to spend $9 million to earn a 70% working interest in the project. The project was very well researched and really well prepared. They put together, they bought 270 kilometers of 2D seismic. They put a big land package together around our state leases. They hired top engineering firms. They spotted the hole. They drilled the hole. It was an enormous physical or technical success. It confirmed the potash of hundreds of millions of tons of potash, very high grade, the highest grade potash deposit in North America, with great economic characteristics and attributes. We would think at that point that it was going to be onwards to production. Unfortunately, at the time, potash had a significant downturn in pricing, went from $700 to $200. They had a very expensive land package to maintain, so they dropped it. We waited for the state lease to expire. When it did, we reacquired it and we founded Sage Potash around that. And we started as a private company, raised about $5.5 million so we could get the program started again. We could put the engineering back on track and begin permitting. So that's kind of my background, and that's kind of how we got to this project. So you don't. Sometimes it's interesting to understand the context of the history. So I'll just walk you through this. I know we don't have a lot of time, and I want to leave enough time for everybody to ask for question and answers. So the key project highlights we'll kind of talk about here. There's 8 of them. Essentially, the long-term potash fundamentals are tied to very long-term global megatrends. And there's essentially two things going on. The world population continues to grow. It's expecting to top out at around 9 billion people. There's also markets that have historically not maintained a good relation with potassium in their soils in Southeast Asia and things like that. These are markets that are now really understanding the importance of potassium. It's potassium and phosphate and nitrogen in equal measure are essential to plant growth. You can't grow plants without those three elements. We have what we can demonstrate as a large-scale, high-grade Tier 1 deposit. There is a potential to satisfy a significant portion of the U.S. demands. We're using mechanical evaporation, and we're going to talk about why we're doing that. We're also presenting investors and shareholders that this is a short-term timeline to production. Most potash projects are 8 to 10 years, and you have to raise billions of dollars before you get started. We've got another approach that is going very, very well. We'll unpack that a bit. 95%, it's actually closer to 97% of the of potash requirements in the U.S. market is dependent on imports. We're using proven solution mining techniques. This is not a science project. And we've put together a very experienced management team. So next. So what we're talking about is a basin that's located in the Four Corners area of Utah, Colorado, and New Mexico and Arizona. And if you look closely at this slide, you'll see that there's ancient seaway access ways. So this basin was flooded a total of 29 times by oceans. And of course, every time they left, they would leave what are called evaporative cycles of sylvite or sylvanite beds. And a sylvanite bed is essentially a combination of NaCl, sodium chloride, and potassium chloride. So the more early events are deeper, flatter, and thicker. But if they're too deep, they're just not economically accessible. If they're too shallow, they get much thinner. As you can imagine, a basin gets shallower and shallower, and you've got subsequent faulting and thrusting, and you get a much more complex geology. So this deposit was, and you'll see that our land package, and we'll zoom in on that later. Our land package virtually controls this entire deposit. This area of our land, is about the size of half the size of Austin, Texas, and that's 90,000 acres, comprised of state, private, mineral, and BLM prospecting permit applications. By being here, we benefit from a cost advantage for transportation to the market of about $100 to $150 a ton. So I'm kind of beginning to show you the advantages of producing potash locally as opposed to imports. We've significantly advanced our engineering towards our PEA, which is a preliminary economic assessment, feasibility, and pilot production. And we're focusing very heavily on pilot production. We've got what we understand is very optimal geology and formation temperatures for low-cost economics quartile. And we're focusing really on domestic food production. In fact, our slogan is American potash for American farmers. There's a lot going on here, so I'm speaking kind of quickly. This is kind of the same region again, but now we're showing the road network, and we're also highlighting why this is an optimal place to be, because what we're talking about is permit friendly. It's one thing to find a deposit that has size and scale. It's another thing to have a deposit that is readily permittable. And we're in this area here between Monticello and Dove Creek, and in this area here, it's high Sierra at 7,000 feet, up in elevation, and we're away from Moab and all the tourism and all the hieroglyphics and the Arches National Parks and Lake Powell and Colorado River. This is a readily permittable area. It's as I said, it's high Sierra, it's pinto beans and red winterweed. So it's essentially readily permittable, and we're quite advanced in our permitting, and we'll unpack that a little bit as we go along as well. This is the land package, and this is also the mapping of the deposit as Dr. Height initially contemplated based on analogous oil and gas wells, where they intercepted and analyzed gamma ray wire logs showing the presence of potash. So the outer hatch is essentially a 20% grade cutoff. The inner hatch is a 30% grade cutoff. And where we drilled, this is a close-up of that, just under here, is 43% KCl. So it's a very, very high grade, very, very thick bed. And we kind of believe this is probably the best place to start, because essentially what you're looking at here, these blue boxes are state leases, and they're readily permittable. And these tan boxes are private mineral acres. So what we have in this area here alone is about 30,000 acres of contiguous acreage. And you need that to have economic well field design and optimized mining units. And we'll talk about what that essentially means. But in this red circle, one of the reasons why I liked this project 10, 12 years ago, the difference between potash and other minerals is that your spacings for determining an economic resource are very wide. You're looking at 3,000 meter spacings as opposed to 30 feet or 300 feet, where you've got to spend tens of millions of dollars over many, many years and risk a project collapsing because of a down cycle in the commodity, in the underlying commodity. With one hole, we've essentially got 280 million tons of potash, and that is more material than we will need, for 100 or 200 years of pretty aggressive production. So this area here is where we're going to start. So this is about 600 million tons. And down here, these are BLM prospecting leases, sprinkle in with state leases. This is the Colorado state line. This is a no-go zone. You've got hieroglyphs, you've got natural parks. It's just not an area that it's worth developing. You're just not going to get permits. So as you can see, we essentially control the entire deposit. Let me just move on to the next here. I keep on pushing the wrong button. This is taken from our 43-101. And, we knew there was this bed here. This bed is about 25 feet thick. So it's got real thick economic thickness for production. And it's got very high grades, 43%, and it's about 160 million tons. When we overhauled to drop in the gamma ray wire log, we discovered a second bed, and that's again about 17 or 18 feet thick, 36% KCl, and another 120 million tons. So a combination of 280 million tons. And this is the area in the red circle, which is expandable with a step out hole of 3,000 meters. We'll get that from potential to inferred and measured and indicated. Hang on here. Sorry about this, folks. So essentially, we talked about the fact that we're not going to have any experimental production, but what we're pioneering is a scalable production approach. And the reason to do that is to get close to cash, and also not get into the market with 1 million or 2 million tons. We're talking about our pilot production we're looking at is about 50,000 tons. And from there, we can expand to on demand, by which people are going to indicate to us, once they see we're in serious business, they're going to indicate to us, well, we'd be interested in 150,000 tons. So after the 50,000 tons is up, which is still about $25 or $30 million in revenue, we can expand on cash flow and on demand. And that gives us a timeline to production of about 1 or 2 years, and we can expand on cash flow. One of the other benefits is that we can have organic certification, because we're not using evaporation ponds or the agents that remain residual in the final product that makes it disqualified for organic certification. Essentially, what we're talking about is an advanced risk mitigation model. Some additional advantages to doing this is that, for at least the next 50 years, from how we understand the geology and the seismic, is that there's very little risk for at least the first 50 years of production. Stage commissioning is a big benefit as well. There was the last big project that came online in North America was in Saskatchewan. It was a $4 billion project for 1 million tons a year. Just before they went into production, they had a problem that they ran into engineering wise. It cost them $1 billion in a couple of years to adjust. So those are the kinds of things that you benefit from starting off the way we're starting. And that's an obvious benefit. We've already talked about the cash flow, and incremental personnel and hiring is also a big benefit, where you establish, your training and your culture gradually, and people coming on board already come in with a running start, as opposed to starting off with 700 or 800 people where you're starting from scratch. So it's there's a bunch of benefits to doing it this way. All right, so Utah is just a great jurisdiction, probably the best jurisdiction as far as I'm concerned on the planet for mining and permitting. They've got a very modern network of infrastructure, low-cost energy and power, access to oil and gas. We are going to need gas. There's a pipeline going right through our project. It's got a very highly educated workforce, especially with a strong focus on mining. And that leads us into where we're starting. We're starting on state leases, and state leases are controlled by the School Trust Land Administration. So the royalties that come from these leases finances the Utah State education system. And they have what I believe is probably the best financed school system on the planet. But that essentially makes the state our partner, and they kind of work with us and walk us through all the steps through all the agencies for both drill permitting and production permitting. So we love working in Utah. It's just it's the place to be. This is what happened 10 years ago. This is the hole that was drilled. That's the actual rig, big oil and gas well, and they went down to 77,000 feet plus, and they encountered cycle 18. Potash beds are continuous, and they're very, very thick, flat lying, minimal dipping, less than 1 degree. We're looking at simple geology. We've got lots and lots of seismic. These are the grades. At the lower bed, we're talking 36% KCl. The upper bed is 43% KCl. That gives us a huge amount of a big fudge factor in terms of setting up our initial operating procedures and making money. And we're looking at a combined pay zone of about 42 feet. And we've got it's very clean. We've got very low insolubles, less than 0.5% or about 0.5%, and virtually zero carnallite. And carnallite is a major problem for production. The primary benefit of this depth is that we have a formation temperature there of 68 degrees. What's interesting there, and we'll talk about that in the next slide, is salt, as you know, goes in a solution in a cup of warm water. 33 to 38 degrees, salt goes into solution. Potash goes into solution at about 62 degrees. We're at 68 degrees, and these are other deposits in production right now. And so if you're below 62 degrees, you've got to spend a lot of money on natural gas to superheat steam to get your cavern and the ability to dissolve potash and bring it to surface. So this really adds to contributes to great economics on production. Hang on. This is our geology. Give you a bit of a sneak peek at that. This is that first state lease. This is where we drilled the hole 10 years ago. This is the gamma ray wire log on that, and you'll see that there's a excellent corollary between the 2D seismic line. That's this section here. It's about 4 miles of 2D seismic, as you'll see here. This is one of those big long lines that we bought. So it's about 280 kilometers of seismic. This is that hole. So this is cycle 18. It's very, very flat. It's very, very thick. So we've got a very high confidence level. This hole here we're looking at here. That's what we're permitting for here. These 3 holes. This will be a cavern development hole. This will be a water access hole, and this will be a disposal well. With those 3 holes, we can begin production of about 50,000 tons a year. And so you'll see that, there's really not a lot of surprises here for us to start and be in production with cash flow quite imminently. We'll walk you through that a bit more. This is just to highlight the benefits of mechanical evaporation versus evaporation ponds. The significantly less water consumption. I mean, even if we could get water access rights, they're prohibitively expensive. This will use about 85% less water, and it's not actual potable water, it's brine. It's got a very reduced land footprint and land disturbance, surface disturbance, much lower visual impact on the surroundings. So we can do enormous amounts of production with a very small footprint. The modular package for systematic staging and production expansion is a big benefit to it. You've also got a lot higher, or you've got really no issues with long delayed springs and expanded or long winters, wet summers. You don't have problems with that, and we have year-round production as opposed to 8-month production. There's a bit more setup money or setup investment, but it's offset by your increased production time and or 12 months as opposed to 8 months, and lower personnel requirements as well. I keep on pushing my button on the screen. This is our roadmap for engineering and for developing the mining units. Essentially, we talked about that one hole. That's going to be this hole here, and that's going to give us the ability to develop the sump of one production cavern. And this will be an injection and extraction hole. And we'll have, we'll be doing our cavern control data and growth and primary mining. And that can be about 12 months from now, we can be in production on this one hole. Essentially, what's going to happen eventually is that you'll have another hole 70 meters away, and that will then have a very large flat cavern that will produce tens of thousands of tons for many years. But this one will be an injection hole, one will be an extraction hole, and then as the mining unit gets developed with us from a single pad and directional drilling, you can access multiple caverns. And so that's kind of the plan for going into production. And that's where our engineering is quite advanced on it. So going back to that state lease, there's a little tuning fork look here. This is where the original hole was drilled. This is where the pad's going to be placed, and all the infrastructure for surface processing. This will be the cavern that we start with. That'll be the disposal hole. This will be water access. But over time, this is a 320-acre section that will be a mining unit. And that mining unit can produce 150,000 tons a year for, upwards of 20 years between, secondary and tertiary mining. What happens with potash, it looks a lot more like oil and gas in many respects, where your discovery hole is also your production hole. So unlike gold or copper or silver or lots of other commodities, there are, you have to spend tens of millions, if not hundreds of millions, to develop or prove up an economic resource. 3 holes, you can have 1 billion tons of measured and indicated with this deposit. But more importantly, with our land position, we've got enough land in contiguous to have 70 of these mining units. So this can produce for a very long time. And we've got so we control the area that we need for that. This has to be adjusted a little bit, but this is what we're kind of already working on towards pilot production. It'll probably be this time next year as opposed to where we looking at, and that's primarily got to do with our permitting, which we're just anticipating momentarily for those next 3 holes. But this is all the activity. This is close to a $30 million project. All in all, and we can show you how we're going to finance that and what we're doing to kind of bring some of those costs down as well. We can talk about that in the Q&A a little bit. So this is kind of the market that we're addressing. It's the truckload market as opposed to having to import and spend rail costs and shipping costs. These are kind of the pricings that are somewhat still relevant to the area. there is some minor slippage in there, but essentially these are the prices right now, and that includes $100 to $150 in transportation costs. Our costs to get to the same market are going to be somewhere in the $30 to $80 range in the truckload market. But just even if we use $500 a ton FOB plant, the economics around being located here are very compelling. We're looking at anticipated production costs of, once we're in full production, of less than $100 a ton. There's very good margins in this. This is the long-term potash demand in North America at this point. At the bottom is Canada. Bear in mind that most of the production is in Canada. This is the U.S. production going forward. So you can see it kind of demonstrates the need for something to happening and to be developed and produced in the U.S. And this is really underscoring the reason why this has to happen. So this is Canada's largest producer of potash on the planet. The second largest producer is Russia and Belarus. But like Canada, they both have a kind of a central marketing agency. In Canada, it's called Canpotex. In Russia and Belarus, they have what's called Belarus-Gali. Combined, they are the largest producer and supplier. And then there's China. So what you're looking at here is of the top four producers, three of them are not really people you want to rely on for your food security. So really underscoring the necessity for developing this project. And our management team that we've talked a little bit about myself. The project has attracted some very interesting people. Pat Avery, formerly the president of Intrepid, he came on board at a time when they brought on their first solution mining expansion. He has been involved in multiple capital equipment projects, multi $100 million projects, hands-on, knows everything about bringing on production, distribution. Basically everybody that's in the industry in that area has either worked for him or worked with him. So we're really well positioned with deep insights and hands-on expertise for bringing a project online. Pat Veras is equally important. Pat's got an amazing track record of resource development. He led the exploration team for Diavik, which was the first large-scale diamond production in North America. He also led the exploration team for Santo Domingo Sur, a big copper, iron, and cobalt project that got bought out by Capstone for $1.1 billion. And he also founded Western Potash and raised $245 million and proved up about 3 billion tons of potash. Of course, they fell into the same problem that we did, where potash prices dropped and on a fluke one-time thing, and we can talk about that as well. But essentially, they had to fire sale the project to a private Chinese group, and that's still some ways off from ever getting into production. They are doing cavern development, but there's a lot of issues that are technically delaying their start. And so what we have the benefit from is understanding firsthand from a guy like Pat, first of all, how to develop a resource, but also the benefits of starting production the way we are, as opposed to what they tried to do, where they stranded, probably risked stranding about $250 million in capital. In addition to that, we've got a board that is, I think you'll see, that's quite focused to M&A or an exit. We've got Matthew Lexier. Matthew has been with Ivanhoe Mines for 25 years, has been a close advisor to Robert Friedland for many years. He's a lawyer. He's also got a strong equity capital markets background. So for M&A and high-level finance, he's seen everything that you're going to see. Gordon Ellis he's a geophysicist, been involved in as a director on numerous large-scale takeouts, and still sits on the board of multi-million-dollar ETF funds. So for corporate governance, he brings a lot of experience to the table. Selma Sierra is an interesting part of our team. She was recently appointed by the governor in Utah to Division of Oil and Gas and Mining, DOGM. So she has spent her career at BLM. She was the director for BLM. She was also the chief of staff for BLM Washington, and also worked for many years for a congressman out of Utah. And her focus was public lands, energy, and environmental legislation. So, we're really well positioned with those skill sets. And to round that off, we've got David Reed, who is our lawyer, but also a director, and he is a global co-chairman of mining at DLA Piper, which is a global mining firm. So, we're quite well positioned to creative financing, high-level financing, and M&As. And that's essentially rounding up the team. What we're ideally suited for is a partnership model, which no importers really can offer that. So we have a short-term production and risk mitigation model, high confidence geology. We can show to existing SOP and MOP. What that is, SOP is essentially, there's two kinds of natural potash or potassium occurrences. One is what's called sulfate of potash, and the other one is called muriate of potash, and that's what we produce. Muriate of potash is essentially potassium chloride, which is used for field crops, wheats and soybeans and corn and things like that. And MOP is used for the more delicate crops, vegetables, fruits, cannabis, fruit or crops that really cannot take the chloride; they get burned by it. So we can actually supply MOP, because MOP is being used more and more to make into SOP. SOP used to come from brines from the Salt Lake, Great Salt Lake. Salt Lake is evaporating quickly, so the chemistry is changing. So we can be a supplier for their MOP to convert to SOP. We can work with distributors, we can work with mixers and blenders, and we can do joint marketing agreements. And so we're quite uniquely positioned to work with the regional market in a way that others can't. This is our existing. This is an old deck. I apologize. This is now about 63 million shares, of which management and insiders control about 63%. That's this block here with the options. Are essentially, this is a 3-year hold. 9 million of this is a 1.5-year hold. So we've got about 18 million shares in the float that was issued at 25 cents. And essentially, we're still a very tight structure. We probably traded 6 or 7 million of that 12 million shares, and so there's about 10 million shares in the float. That's the actual float. So that's essentially. I think I'm getting ready to take Q&A. Possible lithium spin out. Interestingly enough, lithium is also a salt or a saline mineral. Our land position, both for state and for private, we have the opportunities to sample the various brine tables above us and below us for lithium. So there's a potential, basically kicker for additional value for our shareholders. So we created a subsidiary for a potential spinoff for our shareholder base. Another question I've got here is, what countries are the source of potash supplies? I think we talked about that. If there's any more questions on that. What are the infrastructure needs for our project? That's an excellent question. There's about 13 minerals and products that are produced using a lot of the same technologies. we're talking about evaporators, we're talking centrifuges, we're talking screens and filters and granulators. It's typically for all new equipment, even for 50,000 tons a year, that's probably all in, 60, $70 million a year, or 60 or $70 million in CapEx. We have located a 50,000 ton unit that we can buy for about $1.5 million. By the time you move it and you refurbish it and recommission it, it might be $6 to $8 million. So those are the kind of examples and options that we're actively engaged on to put this into production quite imminently. But it's 50,000 tons, 200 tons a day. It's not a large project to start off with. We can have something like that up and running in 6 months. So from there, we can really optimize some of the components and some of the flows and operating procedures, and make some minor adjustments, for the next expansion. And that expansion could be 50 to 150,000 tons, or it could be 50 to 350,000 tons. It really depends on the people that line up, whether it's co-ops, or whether it's people like Wilbur Ellis or Archer Daniels or Compass Minerals. And we'll determine as we go through this 50,000 ton demonstration project, at where we're going to go from to with the final new equipment and things like that. But it's all pretty proven technology. Hope that answers that question. How competitively priced will our potash? Yeah, so we'll be undoubtedly a low cost producer, maybe the lowest cost producer. I can't say that definitively at this point, but on large scale, we're looking at maybe $86 a ton. So we can kind of be profitable through various cycles, and by producing or by getting into production incrementally, we are basically ensuring that we're not stranding capital, but we'll be very competitive. And also with our transportation costs, we can sell for $70, $80 a ton cheaper than imports, and still make that extra $70, $80 that they can't make. A little further on here. I've already talked about MOP and SOP. Good question. We are an MOP producer. That's potassium chloride, which can be stripped and we can be vertically integrated with an SOP producer, which, as you can imagine, will be beneficial to both companies. Any capital needs to move into production? Yes, there are. And this brings me to, probably another question that our people are going to think about. Well, you've got a very small market cap. How are you going to raise money? How are you going to get into production? We're quite advanced, moving quickly on some opportunities that we can negotiate and are negotiating at the project level. So we've got two operating subsidiaries. We've got Sage Potash USA, and we've got Sage Lithium. We can finance right at the project level and at much lower dilution, more realistic dilution, and so that is more than possible. That's how we have to work and proceed on this project at this point. We put something like that together. The capital markets will backfill the value at that point. Not sure if there's any other questions. Thanks, folks.